Tesla's revenue declined last year. That's the first time that happened in the company's history as a public company. Margins are compressed. Price cuts haven't moved the needle. Market share is eroding in the United States, in Europe, and most critically in China, where BYD and a cluster of domestic rivals have taken ground Tesla is unlikely to reclaim at current price points. The $30,000 Cybercab, Tesla's mass-market autonomous vehicle bet, is slated for 2026, but geopolitical turbulence has stalled the regional expansion narrative that was supposed to support it. Gulf Gigafactory ambitions are effectively frozen following IRGC threats targeting major American tech companies, Tesla included. The direct financial exposure in the Middle East is minimal: retail showrooms, service centers, superchargers in Dubai and Abu Dhabi. But the symbolic weight is heavier. Tesla was being positioned as an AI infrastructure company with a global manufacturing footprint. That story now has a hole in it. So the car business alone cannot carry a 200 times earnings multiple. Everyone already knows that. The real question is what the market is actually buying when it buys Tesla at this valuation. The consensus answer is Optimus, Tesla's humanoid robot program, and full self-driving as a software subscription layer. Elon Musk has publicly projected that humanoid robots could represent a market worth multiples of the entire current global auto industry. At the Future Investment Initiative conference, Musk estimated 10 billion humanoid robots by 2040, priced between $20,000 and $25,000 each. That math produces a figure that dwarfs anything in the current tech landscape. Tesla's valuation at 200 times earnings is not a car company multiple. It is a call option on whether Tesla can become the manufacturing and intelligence layer for physical AI. The Cybercab and Optimus share the same underlying thesis, that Tesla's real-world training data, accumulated through millions of vehicles on public roads, gives it a dataset advantage that pure software companies cannot replicate. That is a legitimate structural argument. The data moat is real, and no competitor has accumulated anything close to Tesla's fleet-scale driving data. But there is a critical gap between having the data and monetizing it at the scale necessary to justify the current valuation. That gap is the unresolved tension sitting underneath every Tesla earnings call.
Here is what gets compressed out of most Tesla coverage. The company is not just competing with BYD or NIO on vehicles. It is competing with Nvidia on the AI infrastructure layer, and Nvidia just moved aggressively to consolidate its position. Nvidia's $2 billion investment in Marvell, structured around NVLink Fusion, is specifically designed to keep the AI compute ecosystem orbiting Nvidia's architecture. Nvidia's data center networking revenue reached roughly $11 billion in a single quarter, up 263% year-over-year. That is the pace at which Nvidia is building the physical layer of AI infrastructure. Tesla's Dojo supercomputer, its proprietary training cluster, was supposed to be Tesla's answer, a reason the company would not need to buy compute from Nvidia. But Dojo's progress has been slower than projected, and the competitive pressure from Nvidia's ecosystem expansion makes the standalone compute bet harder to sustain. What this means structurally, if Tesla's AI ambitions require external compute at scale, the margin profile of the robotics and autonomy business gets materially compressed. The vertically integrated story depends on Dojo working. If Dojo underdelivers, Tesla becomes a customer of the very ecosystem it was trying to bypass. That is a scenario almost no Tesla bull model accounts for. The evidence points in two distinct directions, and which one materializes depends on a single variable: whether Optimus and full self-driving reach commercial scale before Tesla's core auto margins deteriorate further. The bull path is coherent. If Cybercab launches in 2026 and achieves meaningful deployment, it converts Tesla's training data advantage into a recurring software revenue stream. Optimus, even at modest initial volumes, begins to shift the narrative from auto manufacturer to physical AI platform. At that point, the 200 times earnings multiple starts to look less like speculation and more like early-stage pricing of a new business model. The downside path is equally coherent. Auto margins continue to compress. China share losses accelerate as BYD and Xpeng close the software gap. Dojo fails to scale as a competitive compute alternative. Optimus timelines slip, as Tesla timelines historically tend to do. In that scenario, the multiple collapses towards something resembling a mature auto company with a promising but unproven side business. The GLG research sell rating reflects exactly this sequence of risks. The threshold event is not a product launch or an earnings beat. It is whether Tesla can demonstrate in verifiable operating data that autonomy and robotics are generating revenue at a scale that justifies the premium the market is already paying. Until that evidence arrives, the valuation is a claim about the future, not a reflection of the present. The asymmetry cuts both ways, which is precisely what makes this one of the hardest single-stock debates in the market right now.